Have you ever seen a business that looks like it's absolutely thriving? Customers coming in, sales strong, the whole place buzzing. A company can be making millions in sales, but still be quietly running out of cash, or carrying more debt than it can actually handle. Looking successful and being successful and financially healthy are two very different things. So, how do you find out what is really going on underneath? That is where the balance sheet comes in. Think of it as like an MRI for a business. Shows you the structure underneath. You do not need a finance degree to read one. Here's the single idea the whole thing rests on. Balance, of course. Picture an old-fashioned scale. On one side, everything the business owns. Its assets, which are cash, inventory, equipment, and property. The other side answers one question. Where did the money come from? There can only be two answers. Either the business borrowed it, or the owner himself put it in. That is liabilities, and that is equity. Take a $1,200 phone. $400 paid in cash, $800 on a carrier plan. The phone itself, that's your asset. The $800 still owed is the liability, and the $400 paid is the equity. Now, let's scale that up to a business. A coffee shop costs $100,000 to set up. Machines, counters, fit out. $60,000 come from a bank loan, $40,000 from your own savings. Both sides land on $100,000. Now, assets get sorted by liquidity, how fast you can turn them into cash. Current assets turn into cash within 12 months. Those include cash in the register, unpaid customer invoices, beans on the shelf. Fixed assets are different. Those are things you keep for years. Think delivery trucks, espresso machines. You don't sell these. You're going to use them to generate revenue. So current assets get you through the month. Fixed assets keep the business running for the next decade. Same shop, two different jobs. Now, let's take a look at the other side. Liabilities. That's basically a fancy word for debt. Liabilities are money the business owes to someone else. Current liabilities are due within a year. Accounts payable. For example, beans that are delivered but not paid for yet. They're short-term loans, wages your baristas earned but have not been paid. Long-term liabilities, those, however, stretch out for years. A bank loan on machinery, bonds sold to investors, a mortgage on the building. Finally, that leaves equity. Here's the cleanest way to see equity. Imagine the shop sold everything it owns today and used the cash to clear every single debt it has. Whatever is left, that belongs to the owner, and that leftover is called equity. But nothing actually has to be sold to work it out. You can calculate it any day. It's a simple equation. Equity equals assets minus liabilities. Big and positive values for equity means the business is genuinely building long-term wealth. However, a negative value means that it owes more than it owns. That is a serious red flag. Put it together with a real set of numbers. On the asset side, $75,000 in cash, $50,000 in receivables, money customers still owe, $40,000 of inventory, $125,000 of equipment, $50,000 in furniture and fixtures, and a $300,000 building. Total assets, $605,000. So, who funded all those assets? First, accounts payable, $35,000. Then short-term loans, $20,000. Then long-term debt, $250,000. And finally, a $150,000 mortgage. Your total liabilities add up to $455,000. The remaining $150,000 is the owner's equity. 605 equals 455 plus 150. Whatever a business owns, someone paid for it. Debt or the owner's money. There is no third option. And the same rule holds whether you are looking at a corner shop or a giant. Now, let's look at the real exciting thing. Apple. This comes straight from their quarterly report. Apple files with regulators. It looks intimidating, but it is just a grid. 2 dates across the top let us compare 2 different points in time. Each row is one item. Read across a row and you see what changed. Cash went from about $35.9 billion to $45.6 billion. Then, when you read down a column, you get the whole position on that date. As of March 2026, $371 billion in assets 265 billion in liabilities, that's 106 billion in equity. Same formula we started with, just a lot more zeros. Now, you have the blueprint to read any balance sheet. You can see whether it's solid foundation or borrowed time. The sheet tells you which. So, next time, don't stop at the headline. Check the balance sheet. Hype comes and goes. The balance sheet, though, that never lies. If this video finally made balance sheets click for you, please do 3 quick things before you go. Hit that like button. It genuinely helps us reach the next person trying to understand this stuff. Share with a friend starting a business. And subscribe to LedgerCraft. Here, we turn confusing financial statements into plain, easily understandable English, 1 video a week. Next up, we've got income statements. Tap that notification bell and we'll see you there.